So, how's Pittman doing in the market?
Pittman Telecommunications Company is a manufacturer and distributor of cordless telephones for both consumers and businesses. Our sales are expected to decline in the long run as cell phones continue in popularity and use in the business and personal telecommunications world. Because of this, the eventual downward trend in revenue and sales, it is our recommendation that Pittman does not invest in producing their own sales force. Instead, we recommend they continue to use the outside sales contractor that is currently employed, even though the commission rate will be hiked.
Carl, where do penguins keep their money?
I don't know where.
In a snowbank. Wah, wah, wah. It does not make sense for Pittman to invest essential financial reserves into fixed costs that would create an increasingly high fixed cost structure. It would make Pittman more vulnerable to the already predicted downward trend in revenue. This cost structure would leave little room for possible profits, and instead would contribute to a decrease in net income over time. As shown by budgeted income statements B and C, keeping the current sales force with a 20% commission rate would produce a net income of over $225,000, which is much more efficient than investing in creating Pittman's own sales force. Additionally, it would keep the cost structure more focused on variable costs, which is very important at the end of a product's life where sales are diminishing.
Furthermore, if Pittman were to employ and invest in their own sales force instead of contracting out, even for the increased commission rate, budgeted operating leverage would be significantly increased to 16. Operating leverage under the increased commission rate would only be 7, as shown by this graph. For this case, high operating leverage is not desirable because operating leverage reflects how much a percentage change in sales will have an effect on operating income. Since we know sales will surely be down in the future, having a high operating leverage would only hurt operating income because we know the change in sales will be negative, thus multiplying the negative change in operating income more so than necessary.
Pittman Communications would expect falling sales in a slowly dying industry in the long run. We suggest Pittman continues to contract sales out to another firm, even if it means higher commission rates, in order to keep this company going for as long as possible.
Oh, Nancy, I forgot to start on the project!
It's okay, Carl. Just wing it.
Oh, Nancy.